Silver is pumping today. Here's what major traders are really watching. Silver is pumping today, and this isn't just another random spike on a chart. This move is being driven by serious capital flows, real macro stress, and a shift in how large traders are positioning themselves in the face of policy risk and geopolitical uncertainty. If you're only looking at the price ticker, you're missing the deeper signal. As of today, silver ETFs are up roughly 3%, reflecting renewed safe haven flows as global risk sentiment deteriorates. At the same time, on major exchanges like MCX, silver prices jumped the equivalent of roughly $85–90 per kilogram in a single session, translating into a sharp move in dollar terms globally. This is not quiet accumulation. This is active repositioning. But the real story isn't just that silver is up. It's why silver is up, and what major traders are watching behind the scenes. To understand today's pump, you have to understand that silver doesn't move for just one reason. Unlike gold, which is primarily a monetary hedge, silver operates in two worlds simultaneously: industrial demand and financial hedging. When those two forces align, price acceleration can become explosive. Today's move is being fueled by renewed geopolitical tensions and ongoing policy uncertainty, particularly surrounding trade dynamics and shifting tariff frameworks. Markets hate unpredictability more than they hate bad news. And when policy stability is questioned, institutions quietly shift toward hard assets. This is where the safe haven narrative comes in. When global uncertainty rises, money rotates defensively. That capital typically flows first into U.S. treasuries and gold. But silver often follows, and because its market is smaller and more volatile, its percentage moves are amplified. Silver ETFs climbing approximately 3% in a single session signals that institutional and retail investors are re-entering the space with urgency. ETF flows matter because they reflect paper demand layered on top of physical fundamentals. When both start tightening at the same time, supply-demand dynamics become sensitive very quickly. Now compare this to earlier in 2026. Silver had previously dropped to cyclical lows amid liquidity tightening and industrial slowdown concerns. From those lows, it rebounded roughly 18% before today's surge even began. That rebound wasn't speculative noise. It reflected structural demand resilience, particularly from industrial sectors like solar photovoltaics, electric vehicles, electronics, and high-tech infrastructure. So today's move isn't starting from weakness, it's accelerating from recovery, and that's an important distinction. Let's break down the mechanics. Silver responds to three primary macro forces. First, real yields and monetary expectations. Second, industrial growth expectations. Third, policy and geopolitical risk. Right now, the third force is dominating. Markets are adjusting to shifting trade policies, renewed geopolitical stress, and legal political uncertainty. When the rules of global trade appear unstable, institutions hedge, and silver benefits from that defensive rotation. But here's the hidden layer most casual observers miss. Silver isn't just reacting to fear, it's reacting to structural repositioning. Large traders understand that silver is in a multi-year supply deficit environment. For several consecutive years, global silver demand has exceeded supply. That deficit has been driven by industrial consumption outpacing mine production and recycling supply. Solar installations alone consume significant amounts of silver due to its superior electrical conductivity. EV production requires silver in control systems, battery assemblies, and power electronics. Data centers and AI infrastructure increase demand for high-performance conductive materials. These trends are secular, not cyclical. So when geopolitical stress rises, institutions aren't just buying silver as a panic hedge. They're buying it as a structurally constrained asset with dual upside drivers. That's very different from a typical fear trade. Now let's talk price levels. In dollar terms, silver is approaching key psychological resistance zones that previously acted as breakout points. Major traders are watching prior high-volume nodes, areas where significant trading activity occurred in previous rallies. If price clears those levels with volume support, algorithmic buying could accelerate the move. But if geopolitical tension cools quickly, silver could consolidate rather than explode upward. That's why traders are monitoring U.S. dollar strength, treasury yield movements, geopolitical headline risk, ETF inflow momentum, futures positioning. The relationship between silver and the U.S. dollar remains critical. A weakening dollar amplifies silver's upside potential because it makes commodities cheaper globally. If the dollar index softens further, while safe haven demand remains elevated, silver could test higher resistance bands more aggressively. Now let's compare this to past movements. During previous global stress cycles, such as 2020's pandemic shock, silver initially crashed alongside equities due to liquidity stress, then rebounded sharply once monetary stimulus flooded markets. That rally was liquidity-driven. Today's environment is different. This rally is not being driven by central bank money printing alone. It's being driven by a combination of policy instability, structural industrial demand, persistent supply deficits, renewed investor positioning. That combination makes this move potentially more durable. Another critical factor, market size. Silver's total market capitalization is far smaller than gold's. That means incremental flows can create disproportionately large percentage moves. When ETF inflows spike even modestly, price reacts quickly. This is why silver often outperforms gold during later stages of precious metal rallies. Gold leads, silver accelerates. Now let's discuss the 18% rebound from 2026 lows. That recovery showed that physical and industrial buyers stepped in aggressively at discounted levels. It demonstrated underlying demand strength even when macro sentiment was shaky. That bounce built a technical base, and today's pump is building on that foundation. This is not a random vertical spike from oversold territory. It's a continuation from structural recovery. Looking forward, broader 2026 forecasts for silver remain constructive. Analysts have highlighted that continued supply deficits combined with electrification trends and geopolitical risk could keep silver structurally supported. Some longer-range forecasts even suggest that if industrial demand accelerates and monetary instability persists, silver could approach significantly higher price zones than current levels. However, that scenario depends on sustained macro tension. If geopolitical risk escalates or policy unpredictability deepens, safe haven flows could intensify. In that case, silver could retest prior highs faster than many expect. But if tensions fade and growth slows sharply, industrial demand expectations could soften, limiting upside. So what are major traders really watching right now? They're not just watching today's pump, they're watching whether this move confirms sustained ETF inflows over multiple sessions, dollar weakness continuation, rising volatility in global equity markets, confirmation of supply tightness in physical markets. If those factors align, silver could enter a momentum phase. If not, this could remain a sharp but temporary spike. Here's the critical insight. Silver isn't just an industrial metal, and it isn't just a fear hedge. It's a hybrid asset reacting to both growth and instability simultaneously. That dual nature makes it powerful and unpredictable. Today's pump is likely not random noise. It's a reaction to policy risk and structural capital rotation. But whether it becomes a breakout or a short-term surge depends on how the macro landscape evolves over the next few weeks. The bigger picture suggests that silver remains one of the most sensitive barometers of global stress and technological transformation combined, and that's why major traders are paying attention. Because when silver moves like this, it's usually telling you something deeper about the global system. Today's surge may look like a simple headline-driven rally, but underneath it reflects a market adjusting to uncertainty, supply imbalance, and structural change. And that's why this pump matters, not because it's up, but because of what it represents. If geopolitical risk continues and capital keeps rotating defensively, this may only be the early wave of a broader structural silver story, not a random spike that fades tomorrow. And that's exactly what serious traders are watching right now.